Welcome back to Investing Talk Podcast.
Today we're looking at Perpetua Resources.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Yep.
And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Perpetua Resources.
Okay.
For the listener, I think it's crucial to frame this correctly right off the bat. We are analyzing a pure development stage mining company.
Right, so no revenue coming in the door yet.
Exactly. This is an execution story, not a revenue story. Well, not yet anyway.
And when you say not a revenue story, I mean, the fundamentals really show that, don't they?
Oh, absolutely.
Our sources show the trailing 12 months net income is pretty deep in the red, negative $22.10 million.
Yeah, and the EPS is negative 0.31 cents.
So clearly, whatever excitement is driving the stock, it's not about current earnings.
Not at all. The entire valuation, really everything, it hinges on the future potential of just one asset.
Which is the Stibnite Gold project up in Idaho.
That's the one. And, you know, the name highlights gold.
Yeah.
And silver's there, too.
But that's not the whole story.
No. The real strategic piece, the thing that's got national interest perked up and gives the company its edge, it's the antimony.
Antimony. Okay, let's unpack the recent news then, because it feels like the last quarter, Q4 2025, was huge for them.
Transformative is probably the right word. They've significantly reduced the regulatory risk around Stibnite.
It really feels like they've cleared some major hurdles, like moving from just paper plans to, well, actual construction.
That de-risking process, it really kicked off back in September. That's when they got the conditional U.S. Forest Service notice to proceed.
And what does that notice actually mean, practically speaking?
It signals they met the key prerequisites, the regulatory hurdles, to actually start serious construction work. It's a massive green light.
Okay, and tied right into that was posting that enormous financial assurance bond. What was it, $139 million?
Yep, $139 million, specifically for the construction phase.
For listeners maybe less familiar with mining development, why is putting up that kind of cash, that bond, so significant?
Well, that bond is basically a guarantee. It's Perpetua saying to the regulators, to the community, look, we have the money set aside to cover full environmental cleanup and remediation.
Even if something goes wrong with the project down the line.
Exactly. Even if it gets halted or, worst case, fails.
Okay.
So for investors, it takes a lot of that environmental and permitting risk off the table. Shows they're serious and capable.
And then the physical proof followed pretty quickly, didn't it? October saw the official groundbreaking.
That's right. Starting early construction work at Stibnite, that's the moment. You know, they went from talking and negotiating to actually moving dirt.
Shovels in the ground.
Precisely. And what's interesting is how the company's own structure immediately mirrored that shift.
You mean the CFO change?
Yeah, bringing in Mark Murchison to replace Jessica Largent, that's not just moving chairs around.
No, it feels like a signal.
It's a clear signal. They're pivoting. Moving from focusing mainly on regulatory stuff and early capital management towards aggressive, large-scale project execution. And, crucially, financing the full build-out.
Right, and executing a project this size needs serious capital.
Which brings us to that other huge piece of news from October.
The $255 million private placement.
Yeah, that's a massive vote of confidence. Money like that doesn't just show up without some serious belief in the project.
Absolutely not. And you have to look at where that money came from.
Okay, who are the investors?
$180 million from Agnico Eagle. That's a major respected mining player.
Okay, that's significant strategic validation.
Definitely. And the other $75 million came from JP Chase. A huge financial institution.
And both of them got warrants as part of the deal, right?
They did. Both received warrants.
So if I'm an existing shareholder, I see warrants and I think, okay, Agnico and JP Morgan can buy stock later at a set price. Is that good, or is it just setting up future dilution?
Well, it's a bit of both, really. It depends on your time frame.
Short term. It's overwhelmingly positive. That $250 million is specifically for developing Stibnite and for working capital. For a company not yet earning revenue, that cash provides a crucial runway.
Okay, keeps the lights on and the project moving.
Exactly. Longer term. Yes, you're right. When those warrants get exercised, it will dilute the existing equity holders. No way around that.
But the bet is?
The bet, the strategic calculation, is that the increased confidence and the successful execution enabled by that capital injection will push the overall share price up enough to more than make up for that percentage dilution.
Got it. Okay, this feels like the point where the analysis shifts gears a bit. Moving beyond just the mining aspect and into the strategic value, the antimony.
Yes. This is where Perpetua really stands out.
Yeah.
We need to talk about that competitive moat built around antimony and, importantly, the national security angle. This is sort of the aha moment for understanding the stock's potential.
So what makes it so unique?
It's not just another gold prospect. Perpetua Resources is positioned as the only advanced-stage U.S. miner that can supply both antimony and gold at a significant scale.
And antimony elements for the chemists out there, you mentioned it's critical.
Designated as a critical mineral, yes. Its uses are vital in both defense and increasingly in energy sectors.
Okay, for listeners maybe not up on their mineral chemistry, why is this element so important right now? Is it just for niche military stuff or broader?
It's actually both. Its main use historically is as a flame retardant, and it strengthens some metal alloys. But the critical use is defense.
Like what specifically?
It's fundamental for making things like tracer bullets, primers, certain high-performance military components, and, crucially, thermal imaging, think night vision goggles.
Okay, so pretty essential stuff for modern military tech.
Absolutely. And then on the clean energy side, it's popping up as a key component in things like flow batteries.
Which are needed for grid storage, right? Long-duration stuff.
Exactly. Essential for making renewables more reliable.
And if you layer the geopolitical situation on top of these uses, relying on foreign supply starts to look like a major risk.
A huge national security vulnerability. That's the core issue. Right now, almost all the world's antimony comes from basically two places.
China and Russia.
China and Russia. So the Stibnite project isn't just a mine. It's potentially a globally rare domestic source that could secure the supply chain for the U.S. military and defense contractors.
So that strong alignment with federal priorities, the Department of Defense needing secure supply, does that mean Perpetua isn't just selling a commodity, they're selling something more like a strategic asset?
That's a great way to put it.
And could that translate into real market advantages, maybe better pricing or even direct government help?
It absolutely could. When a mineral is critical for national defense, the normal rules can change. You might move beyond just fluctuating spot market prices.
How so?
Well, the government might prioritize guaranteed volume and secure origin over just the lowest price. That could mean premium pricing, maybe faster permitting, especially with all the concerns around potential Chinese export restrictions these days.
Okay, that paints a very, very bullish picture. But we need to balance this, right? Look at the financial reality today.
Absolutely essential. We need the counterbalance.
The market cap is around $2.73 billion. For a company not making money yet, that seems...
Well, it suggests the market has already priced in a lot of success.
That's a very fair point. A high valuation for a pre-revenue company definitely means massive expectations are baked in.
Doesn't that imply the margin for error for investors coming in now is pretty thin?
It does carry that risk. The financial reality is stark. Free cash flow is negative because they're spending heavily on development. They're deep in that capital expenditure phase.
And while the $255 million helps...
It helps, but finishing a mine of this scale costs billions. Billions with a B. So they are guaranteed to need more money down the road.
Which means future debt, or more likely equity raises. That inherent dilution risk is significant, even with Agnico on board. It's just part of the game for a developer.
Is there anything on the balance sheet now that kind of offsets that future risk a little? Any positive leverage?
There is one major structural advantage they have right now.
What's that?
The company carries basically no material long-term debt.
Ah, okay. A clean slate.
A very clean balance sheet. And that provides immense flexibility. When they get to the stage of putting together the main project financing package, the really big debt facility, they aren't tangled up in existing loan agreements or covenants.
Makes it easier to negotiate good terms for the big loan they'll eventually need.
Much easier.
Yep.
So yes, execution risk is high, dilution risk is always there. But what's the absolute biggest risk factor? The one thing that could derail everything?
Let me guess. The permits.
It all boils down to regulatory and permitting risk. Despite the great progress the notice to proceed, the groundbreaking, the single largest threat is still some unexpected delay or, the nightmare scenario.
Rejection of the final permits for Stibnite.
Exactly. If that project doesn't get the final green light to actually produce, the equity value would be crushed, maybe terminally. Everything, absolutely everything, rests on getting those final approvals and making the transition to production successfully.
Okay, let's shift to what's coming up soon. Near-term catalysts. Even without revenue, the next earnings calls will be watched like a hawk, right?
Intensely scrutinized.
Yeah.
We've got Q3 earnings expected around November 12th, then Q4 likely in February 2026.
And since the revenue line will be zero, what are investors going to be focusing on?
It's all about the management commentary. People will be parsing every word about cash usage, the burn rate, and, most critically, any updates on the construction timeline. How is that big capital injection being deployed? Are they hitting milestones?
Makes sense. And with big new shareholders like Agnico and JP Morgan, does that make other market events more significant?
It definitely can. You'll want to keep an eye on things like the ETF quarterly rebalancing. There's one around November 15th, and the institutional holdings update, usually around December 20th.
Why those specifically?
Well, when major strategic players take stakes, it puts the company on the radar for index funds, or changes how it's weighted in existing ones. These flow events, as they're called, can sometimes cause short-term volatility, as big funds have to buy or sell shares based on index rules, not just company fundamentals.
Interesting. Yet, despite all these risks we've discussed, the analyst view seems incredibly positive.
It is. The consensus rating is a strong buy, and the average 12-month price target is up around $25.38.
Wow, okay. Compared to where it's trading now, that's optimistic.
It highlights that unique strategic position we talked about, the antimony factor. And some of the really bullish analysts, we've seen targets reaching as high as $44.
And the charts back that up?
Technically, yes. The stock's been trading comfortably above both its 50-day and 200-day moving averages. That usually confirms strong underlying momentum and suggests institutions are supporting the price.
Okay, lastly, we can't ignore the speculation, the rumors that are kind of swirling around the company. These could be game changers if they pan out.
Right, there are a few big ones. The biggest probably relates to financing the rest of the project.
What's the buzz there?
There's talk, highly speculative, mind you, about a potential huge debt commitment from the Exxon Bank, maybe up to $2 billion.
$2 billion. Okay, that would be transformative.
Absolutely. If that non-binding interest somehow turned into firm, low-cost government-backed financing, that would pretty much solve the main funding challenge without needing massive, really dilutive equity sales. It clears the biggest financial hurdle by far.
And given the strategic nature of antimony, are there rumors about other kinds of government support too?
Yes, there's growing anticipation, or maybe hope, that the U.S. government might roll out new federal critical materials incentives that could benefit Perpetua, or maybe even grant the Stivnod project some kind of expedited status.
Which would help with permitting speed and certainty.
Exactly. That kind of official backing would not only potentially speed things up, but also help solidify the long-term value proposition, especially tied to defense needs.
And the final bit of speculation involves actually selling the antimony, off-take deals.
Yeah, we're hearing unconfirmed rumors stress unconfirmed about advanced talks for off-take agreements, specifically with North American defense contractors or maybe tech companies for the antimony.
What would securing a deal like that mean?
Oh, huge. Locking in a long-term agreement for a set volume at a fixed price. That would immediately de-risk a big chunk of their future revenue. It provides stability, makes it easier to satisfy debt requirements, and starts to justify those high analyst valuations by turning speculation into predictable future cash flow.
Okay, so let's try to pull this all together. Synthesizing the unique risk-reward here for Perpetua Resources.
What you're looking at is definitely a high volatility stock. It's pre-revenue. Success hinges really entirely on perfect project execution at Stivnod. Get the permits, build the mine on time, on budget.
But the flip side?
The upside is potentially immense. They're positioned not just as another gold miner, but as a potentially vital strategic national supplier in a global market for a critical mineral that's increasingly contested.
Right. So here's a final thought, maybe a question for you, the listener, to ponder. Since so much of the long-term story hangs on that secure domestic supply of antimony for defense and tech, how should you weigh that geopolitical supply chain risk, which actually benefits the company, against the more traditional mining execution risk, the hurdles they have to overcome?
That trade-off, that balance, that's really the central question when you're analyzing this company, isn't it?